Okay, good morning, everyone. So let's start with today's session. My name is Kushagra, and I'll be taking you through this subject of financial accounting for managers. And if you look at the basic intention of this course, uh, can you all hear me, or somebody could just ping me and let me know if you could hear me? Okay, fine. That's great then. Okay. Yeah, thanks. So the basic intention of this course is not to make you an expert in accounts. That's not the main intention. The basic goal or reason why we'll go through the subject is that in case, let's say, somebody puts or tells you, okay, what's your view about the company? And you go through, let's say, the financials of the company, it doesn't appear like Greek and Latin for you. So at least you should have some idea as to what's happening in the company. Where do you look at so that you can get some information about the financials of the company? How do you decide whether it's a good company or a bad company? At least some basic idea. So that's the main intention of this course, and this is what we'll be covering in the next 10 sessions. 10 hours or 4 sessions each. So I'll just take you through what we'll be doing in each session. So if you look at the first session today, it's all about introduction. So today we go through what are financial statements, different types of financial statements that companies make. So they basically make three types of financial statements. You'll have the balance sheet, you'll have the income statement, and then what you have is a cash flow statement. So today we'll be covering the first two in depth, that is the balance sheet and income statement, and we'll touch base upon the cash flow statement today. And next session we'll cover cash flow statement in detail. And once we are done with, let's say, the balance sheet and the income statement, we'll also look at how companies evolve and grow when they're at the introduction stage, maybe the growth, the maturity stage, or the decline stage, and how your balance sheet changes once you move from one phase to the other phase. Similarly, how your income statement changes once, let's say, you're at the introduction stage, and what happens when you're at the growth or the maturity or the decline stage. So we'll also look at the life cycle and its relationship with the income statement and the balance sheet. So this is what we'll be covering in today's session for the next 2.5 hours. Then in the next session, which is live session 2, we will cover accounting concepts. What are the users, who are the people who go through the financial statements? We look at what's an accounting equation, and we look at what's a cash flow statement. So today we'll just have a basic intro of what is a cash flow statement. Next session, we deep dive and look at what's a cash flow statement, how do you make a cash flow statement, what sort of interpretations can you do with respect to a cash flow statement. We look at a live company, and I'll take you through the cash flow statement of that live company. Accounting equation, it's a very simplistic way through which you can make your income statement and a balance sheet. So even if you are from a non-commerce background, then using this accounting equation, it becomes easy for you to make the income statement and the balance sheet without going through, let's say, a debit or a credit, which typically an accountant would be doing. So this I'll be covering in the second session. We'll also look at various users who go through the financial statement. So let's say you plan to invest in a particular company. So you're an investor, a potential investor. So you would be looking at the financials. Maybe the government would be looking at the financials of the company. The tax department would be looking at the financials. If you are an analyst who's tracking a company, you would be looking at the financials. So we look at various users, why they go through it, what sort of information they're tracking and looking at. All of this we'll be covering in the next session. And we'll also look at various accounting concepts and conventions. So we look at around 7 8 accounting concepts and conventions, and we'll cover all this in the next session, that is live session 2. So this is the various accounting concepts that we'll be covering. Then we go through users, we look at an accounting equation, we look at typical examples, we'll solve or we'll go through a caselet, and then we look at a cash flow statement. Then finally, in the third session, we start analyzing companies. And the basic tool for analyzing a company is your ratios. So ratio is a very simplistic tool and a basic tool which is used for analyzing companies, which could give us information as to what's happening within the company. And there are basically four different types of ratios. You have the liquidity ratio, the profitability ratio, the solvency ratio, and then you have one more, which is your turnover ratio. So in session 3, we'll be covering these three, which is liquidity, profitability, solvency. Again, let's not get into it. What is liquidity? What is profitability? What is solvency? We'll cover that in the third session. So we look at all these ratios in the third session. And finally, when we move to the fourth session, we look at the fourth ratio, which is the turnover ratio. Along with this, we look at something which is known as a DuPont analysis, which again talks about, if I'm a shareholder, then how do I actually, let's say, analyze a company and see whether this company is better than the other company or not, whether it's giving me a higher return or not, and on what basis is it giving me a better return. Is it because that it is fundamentally a strong company, or is it that maybe it's taken more debt because of which it's giving me a higher return? All of this will get captured in the DuPont analysis. And then we also look at other financial tools which can be used for, let's say, analyzing a company. That's basically your comparative statement and the common size. So this is what we'll be covering in the fourth session. So this is typically an overview of what we'll be covering in the next 4 sessions. Any questions till now? Anyone? If you have any questions, please feel free to unmute yourself and stop me then and there. I'll be more than happy to answer it. Yep. Otherwise, we start. Okay, fine. So let's start with the first thing. Now, I'll just move to the whiteboard. So let's say I want to start a company. So if I want to start a company, the first thing that I need is money. So I'll raise some money. Now, what do I do with this money? With this money, maybe let's say if I'm a manufacturing company, then what I'll do is I'll buy some machines and asset so that I can produce goods. So I'll buy some, let's say, property, plant, equipment, maybe some machine. So typically what I'm doing is I'm buying something so that I can use it to produce goods. Then I'll also buy some raw material. So I'll do some purchase. So I'll buy the raw material. Using those machines, I'll convert that raw material into finished product. And finally, I'll sell those products. And when I sell it, I could either make a profit or maybe loss. And in this entire process, I'll be incurring some cost. I could be generating some revenue, so on and so forth. So I could be incurring some expense, and I could also be generating some parallel revenue, not just the revenue that I generate when I sell my goods or I render my services. I could be generating some other revenue also. For example, let's say I've done some investment because of which I'm getting some interest income or I'm getting some dividend income. All of that would get captured over here. Now, when you do all of this, you need to record it in one place. So when you record all the transactions on a daily basis in one place, that one place is known as journal. So let's say on 1st of April, you raise money from your friends. And let's assume hypothetically you've raised 100 crores from your friends, relatives, or maybe you've gone to the market, you issued shares, you've taken a loan, you've raised 100 crores. Then maybe on 2nd of April, you go and buy some machine. Then on 3rd of April, let's say you purchase some raw material. Then 5th of April, you sell your raw material. Similarly, on a daily basis, you'll have all these transactions. So these transactions are recorded in one place, which is known as a journal. And this is done in a chronological manner on a daily basis. Any doubt with what's a journal? Anyone? So you just record the transactions that are happening on a day-to-day basis. Any questions with respect to a journal? Fine. Now, once the transactions are recorded in the journal, okay, Abid, you've raised in hand. Again, no, a journal is, what you can do is you can have your own books of accounts. So typically what a lot of companies do is, let's say you could have a software where you have a journal already made. So you just have to write the entries and it automatically gets captured in the journal. So maybe you could use a software like Tally or any other software like Oracle or anything. So you could do that. Okay, because turnover is very high nowadays, manpower is split across departments. Noted. So again, typically today everything is automated. So you just do the entries and everything automatically, the system at the back end will, from move it to the journal. So it's not an old system where you write it on a sheet of paper or you do everything on Excel. So nowadays it doesn't work that way. But again, from an understanding point of view, this is what the accountant would be doing. He'll be recording transactions on a day-to-day basis, and finally they get captured in a place which is known as journal. Any questions with this before we move forward? And let's move further. Now, once this gets recorded, then what you do is you move to something which is known as a ledger. Now, what's a ledger? Let's say I've raised money and I've taken a loan. So I'll have a loan account. So I'll have a loan account. So this is typically how an accountant would be making a loan account. It's a T format. You'll have the left hand side and the right hand side. Then you bought some machine. So maybe you'll have machine account, and you've got different machines. So you could have machine one account, machine two account, so on and so forth. So you will have different machine accounts. Then let's say you've purchased raw material. So you'll have a purchase account. Then you sold goods. So you'll have a sale account, so on and so forth. And you keep recording all these transactions over there. On once you have these transactions over here in the journal, then you keep transferring them from the journal to the ledger. So let's say this 100 rupees which was recorded in the journal and you've raised money, I'll transfer it to the loan account. Then I bought a machine, so I'll transfer it to the machine account. So let's say it's machine one, machine two, I'll transfer it over here. Then I purchased raw material, it'll get transferred over here. Then I've sold goods, it'll get transferred over here. So let's say this is my loan account. So I'll keep recording all the transactions one below the other. And finally, towards the end of the year, I get to know what is the total loan that I've taken from a bank. Similarly, if I'm looking at machine one account, I get to know what is the total value of the machine at the end of the year. Similarly, if I look at the purchase account, I get to know what's the total purchase for the year. And if I'm looking at sales, I get to know what's my sale for the year. So towards the end of the year, from the ledger, what I do is I make a trial balance. So what's a trial balance? I look at the balances which are appearing in these individual accounts and I write it. So I'll have a trial balance, something like this. So I'll have loan. So let's say my loan account is, I've raised 150 crores. So maybe I'll have 150. Then I've got machine one account, machine two account. So machine one, I bought asset worth, let's say 20 crores. Machine two is an asset worth 35 crores, so on and so forth. So I look at what's the balance at the end, and that's noted down in a trial balance. And from this trial balance, finally, what I make is a balance sheet and an income statement. So using this trial balance, I'll make the balance sheet and the income statement. So any doubt with the balance sheet and the income statement? I mean, any doubt with the process? So the process is you have the journal, then you'll have the ledger, then the trial balance, and finally your financial statements, which is basically your balance sheet, income statement, and the cash flow statement. Any questions earlier before we look at balance sheet and income statement in detail? Trial balance, one more example. Fine. Okay, let's look at it. So let's say I made this loan account. Okay. And I took one loan worth 100 crores. Then I took another loan worth 50 crores. So what's the closing balance at the end of the year? The closing balance at the end of the year is 150 crores. So this 150 crores, I'll transfer it to the trial balance and I'll say, okay, throughout the year, whatever transactions have happened, what's the closing balance of that? I'm saying I've got a loan worth 150. Similarly, I'll go to the machine account. I'll say, okay, throughout the year, whatever has happened in the machine, it is getting captured in this account. But what's the closing balance? That closing balance will come over here in the trial balance. Yeah. So in case of a journal, what you do is it's just a consolidation. So in journal, you just keep recording the transactions on a day-to-day basis, be it for the loan, be it for machine, any transaction. Then from the journal, you segregate into different categories. So I'll say, okay, all loan transactions will move to the loan account. All machine transactions will move to the machine account. All purchase transactions will come to purchase. All sales will go to the sales. Similarly, you could have hundreds of different accounts. So you transfer all these transactions to these accounts. Then in these accounts, you get to know what is happening throughout the year. Finally, what you want to know is what's your closing balance. Your closing balance, you get to know from your trial balance. And then using this trial balance, you'll make your income statement and the balance sheet. Any doubt with the process? Okay, then let's move further. Fine. Now, there are basically three important financial statement that the company makes. The first one is a balance sheet. Then what you have is an income statement, and you also have a cash flow statement. So these are the three most important financial statements that a company would make: a balance sheet, an income statement, and a cash flow statement. Let's briefly understand what is a balance sheet. A balance sheet basically is made, which tells you what are the assets that you have and what are the liabilities that you owe. So asset is nothing but any resource that the entity has, and which will be used, let's say, to produce goods or render services. For example, I bought that machine, so that machine is an asset. I've got stock, raw material, so that raw material will be used and I'll convert it to finished goods, and those finished goods will be sold to generate revenue. So an asset is any resource which will be used to produce goods or render service. Similarly, if I look at, let's say, a liability is something which you owe to an outsider. So let's say you've taken a loan. That loan is a liability. I have to make a payment to the banker. I've purchased goods from someone on credit. I haven't made a payment. So that person, my supplier, I have to make a payment to that. So all of that will come under liabilities. I'll have assets. And also have one more category, which is known as shareholders fund. So any doubt with the basic idea of what's an asset, what's a liability, what's a shareholders fund before we look at each of them in detail? What's an asset, what's a liability, what's a shareholders fund? Okay, what's an asset? An asset is nothing but any resource which will help you in generating revenue in future. So let's say I go and buy a machine. This machine will be used for producing goods. Once the goods are ready, I'll sell them and I generate revenue. So an asset is a resource which will help me in either producing and selling goods and generating revenue, or rendering services and generating revenue. So that's an asset. You could have different types of asset. We'll cover that later, whether you could have a long-term asset or short-term asset. So that's an asset. Okay, the question is employee or human resource as an asset? Now, if I'm looking at an IT company, the biggest asset for an IT company is employees. But the problem is I don't record employees as an asset in my books. So for an accountant, the employee is not an asset, because see, again, try and understand. Let's say if I go and take a loan from a bank, I can give the machine that I have, or let's say the building or the factory that I have, I can give it as a collateral. I can give it as a guarantee to the banker that in case I default, you can sell it off and recover the money. I cannot go and tell the banker that, let's say I'm Infosys or any other company, I've got lakhs of employees with me, I want to take a loan. If I default, take employees as a collateral and do whatever you want with them. So employees, although they are the biggest asset for an IT company or maybe any service entity, but they are not recorded in the books because it's difficult for you to give a proper value and say that, okay, this employee's actual worth is this much, and this is the value at which I'll record X employee in my books, Y employee in my books. So that is why employees are not recorded as assets, even though technically they are assets, because they are the ones who are creating the maximum value in your company. Any doubt with asset before we look at liabilities and shareholders fund? Fine. Then let's look at a liability. Now, liability, like I said, is something which you owe to an outsider. So I go and take a loan. It could be a long-term loan. It could be a short-term loan. I'm liable to pay to someone. I have to pay salaries to my employees. So again, it's a liability for me because I owe the amount to my employees. So again, that will be a part of liability. I have to pay dividends to my shareholders. So again, that's a liability. I have to pay taxes to the government. So again, that's a liability. So all of that, if the amount is not yet paid, then I owe that amount and it becomes a liability, and I'll show it in the liability. Again, this could be a long-term liability. It could be a short-term liability. We'll cover that, let's say, in the next half an hour or so. And then finally, if I look at a shareholders fund, what is a shareholders fund? Shareholders fund is the amount of money that belongs to the shareholders. So shareholders fund basically will consist of the money that they've pumped in, which is the share capital. So let's say you are a shareholder of Reliance Industries. You've bought shares. So you get the shares and in turn you give money to Reliance Industries. So that's the share capital for Reliance Industries. So the money given by you to the company is share capital. Similarly, other people would have bought the shares. So that again is a share capital. Along with that, the company will generate profits during the year. That profit also belongs to the shareholder. So that again is a part of shareholders fund. So shareholders fund will consist of share capital and the profits and losses, which typically is known as reserves and surplus. So any doubt with the basic idea or an overview of what is an asset, what's a liability, what's a shareholders fund? Okay, got a question. Bank loan is used to buy machines and generate revenue. It's an asset. First of all, I go and take a loan. So money will come in. Using that money, I buy an asset. So I buy a machine. So this machine that I buy is an asset, which will be used to produce goods and render services and generate revenue. But this loan is a liability because I have to repay the money to the banker. Okay, got a question. What if a company is not publicly listed? Then will it still have shareholders component? Now, again, see, if it's a entity which is not private, I mean, it's private, it's not listed on the stock exchange. Typically, what will happen is you'll get money from your friends, relatives. That again will be shareholders funds. But it's just that those shares are not trading on the stock exchange, but you still have the money which is there. So maybe it could be a venture capitalist that has funded you, a private equity, or maybe your friends, relatives have given you the money, so they'll have stake in the company. You'll still have shareholders funds. Yeah, so you'll have investors fund. Yeah. Okay. Shareholders fund. Okay, got a doubt with what's a shareholders fund? Can you please repeat it? Okay, fine. Let's say you're starting a company, and for starting the company, let's say I'm looking at a company like, let's say, Microsoft. Microsoft came out and got listed somewhere in the 1980s. If I'm not wrong, it got listed somewhere in 86, 87. So what they did is they came out with their shares and they told the public in a simple language that, are you interested in buying the shares? If you are interested in buying the shares, each share will cost you, let's say, $5, $10. I'll give you one share, and in return, you give me $5, $10, whatever was the amount that was fixed at that time. So the company will issue shares, and what they'll get is cash. So they'll issue shares, and what they'll get is money from the investors. So people like you and me, I'm just writing, let's say XYZ, we will invest money. We are known as shareholders. And we have given money to Microsoft. So this money that the company receives is known as share capital. So this share capital belongs to the shareholders. Along with this, the company will be generating revenue, or maybe it's incurring a loss. So that profit or loss also belongs to the shareholders. Put together, this is known as shareholders fund. So shareholders fund is the fund which belongs to the shareholders, either the share capital or the profits and losses. Yep. Any doubt till here? Yep. Jyotishman, you have raised your hand. Yeah, tell me. Yep, tell me.
Hello, sir. Sir,
Yeah.
I have a question.
Yeah.
That suppose I take a loan and I purchase the machines. The machine comes under assets. The machine values probably.
Yeah.
So if I take the loan and I purchase the machine, then won't there be a double entry in the balance sheet?
So let's say what will happen. So let's say if I'm making a balance sheet, and let's say for simplicity, I'm making it in a T format. I'm not making it in a vertical format. You can make it, I mean, typically now companies, what they do is they make it in a vertical format. So the first thing that you're doing is you're going and taking a loan. So
Yes,
loan
sir.
is a liability. So I'll have a
Yes.
loan over here. So let's say I've taken a loan of 100 crores.
Yes, sir.
So when I take a loan, I create a liability. At the same time, the banker is giving me money. So I'm just writing it as cash. So this is what will happen in my balance sheet. I take a loan. So a liability comes in my balance sheet, and I also get cash. That is money, which is worth 100 crores. Then
Yes,
what
sir.
do? I use this cash, and let's assume I use the entire cash to buy an asset, which is a machine.
Yes.
So I'll buy this machine. This cash will go out.
Hmm.
So now in my balance sheet, what happens is I've got an asset worth 100 crores, which I will be using to produce goods or render services or do whatever I want to generate revenue. And I also have a corresponding liability which I have to repay to the banker, depending upon what's the tenure, 5 years, 10 years, 1 year, whatever it is. So this is what will happen when you go and take a loan and you use that loan to buy an asset. This is what will happen in the balance sheet.
Okay.
Yeah. So you'll have
Okay.
a corresponding entry. So you'll have a liability, you'll also have an asset.
Okay. Thank you, sir.
Okay, now let's look at the balance sheet. Let's deep dive a little bit and look at a balance sheet. So as of now, what we know is a balance sheet has three components. It has the assets, it has the liabilities, and it has the shareholders fund. So let's say if I'm making a balance sheet in a T format, I'll have assets, I'll have liabilities, and I'll have shareholders fund. These assets could be either long term or for short term. So if they are for long term, the accountants typically call it as a non-current asset. And if it's for short term, it is known as a current asset. So if you've got an asset which you will be using for long term, for producing goods, for rendering services, there is no intention to sell them in the near future, that's typically 1 year, then you categorize all such assets as long term assets, which is a non-current assets. Otherwise, assets will be short term assets, which is known as current asset. So any doubt with this bifurcation, non-current or long term, and current, which is short term? Okay. Yeah, Abid, you've raised your hand. Yeah, Abid.
Hello, good
Yeah, Abid.
morning.
Yeah, good morning, Abid. Tell me.
So just wanted you to take me through two things. First is this NCA, that is the non-current assets, and second is that just wanted to ask. So ideally, in a listed company, as a stock listed company, the SHF may be maximum at 49%, right? If I'm not wrong.
Yeah. No, in a listed company, why? 49% of what? The total
49%
capital?
would be the shareholders fund, and the 51% would be owned by the owner, like in a
No,
listed company.
no, it's not necessary. I mean, you think Mukesh Ambani owns 51% in Reliance Industries? No.
Probably.
No. If you look at Mark Zuckerberg, I'll tell you, Mark Zuckerberg in Facebook owns 13.7% only.
So it's
So
a
again,
complete. If I understand that Meta is a complete public-owned company.
so it's a public owned company, it's a listed company, right?
Right.
Yeah, and you wanted me to take you through what? Non-current assets.
Yes, sir.
Yeah. So again, what are non-current assets? These are assets which are held for long term. So let's say you're buying a machine, you're setting up a factory, you have a go down, you bought some land, or you're constructing a building. Now, all these assets will be used for long term. You will not be, let's say, making a factory with an intention that you sell the factory in the next 6 months or 1 year. You buy a machine, you buy it with an intention that you'll be using it for the next 5-10 years to produce goods. So all those assets which will be used for long term without an intention of selling them in the near future will be a part of non-current assets. Others will be a part of current assets. Any doubt with the basic classification? Okay. Then let's look at non-current assets. Non-current assets, I could again split them. I could have tangible non-current assets. I could have intangible non-current assets. I could have something which is a capital work in progress. And I could have other non-current assets. So non-current assets could be either tangible, they could be intangible. Okay, how long is long term? For an accountant, from an accounting point of view, this is 1 year. So we are not looking at tax where we look at long term capital gain or short term capital gain and we look at 3 years. No, for an accountant, it's 1 year. So if you intend to hold it for more than a year, long term, within a year, short term. Okay. If any asset which comes under non-current asset will change to current asset in any case, yeah, it can change. For example, let's say you have an asset, you bought a car. That car was used for the, let's say, the last 5-10 years or whatever it is, and you've been using it. So when you bought it, it was a non-current asset. But now you intend to sell it off because the car, the value has gone down and you're spending more on repair and maintenance. So you, as a company, you've decided that we have to get rid of this car and we'll buy another car. So that non-current asset, which was a non-current for, let's say, the last 5-10 years, will now become a current asset, and you show it as a capital held for sale or an asset held for sale because now you intend to sell it in the next 1 year or so. Yep. Okay. Okay, got a question. When IT companies procure hardware systems from another company on contracting basis, is it non-current or current? Again, depends on the tenure, whether you're taking that hardware asset for a year or more than a year. If you're taking it for more than a year, non-current. If it's short-term, current. So the basic idea of splitting it or deciding whether it will be non-current or current is see whether you want to use it for long term, that's more than a year, or you will be using it for less than a year. If it's more than a year, non-current; less than a year, current. Okay. Okay, Naveen has raised hand. Yep, Naveen.
Sir, I have a question like in deciding as a current and non-current asset.
Mhm.
So on what basis? Basically, on a business note, why would a customer or why would anyone decide an asset under non-current or current? I mean, what could be the criteria of their this thing, sir? I mean, I'm still not clear on the definition of current and non-current asset.
Okay. Now, let's say you're running a business. So for running a business, you'll need some assets. For example, let's say you buy computers.
Yeah.
Okay, you've got some furniture fixture. Okay, so then you've got some building where you have your office, you've got a warehouse, then along with that you also have stock,
Yeah.
you've got some cash balance, bank
Yeah.
balance, whatever it is. Now tell me, this computer, are you intending to purchase computer and sell it off within the next 3 months, 6 months, or 1 year, or once you buy a computer or a desktop for your
It
employee,
becomes my
you
asset.
intend to use it? It's an
It
asset.
becomes my asset. Yeah.
It's an asset. All of this is an asset. But tell me,
Yeah.
when you buy a computer, do you intend to use it? Assume that it will be used by an employee for 6 months, 9 months, and then you'll sell it off and replace it on another computer, or you say no, once I bought a computer, let's use it for another 3, 4, 5 years.
Yeah, that's how it is. Yeah.
Which means I'm saying that it's an asset which is held for long term.
Yeah.
So I'm splitting assets into long term and short term. So if it's
Okay.
long term asset, I say it's a non-current asset. If it's short term, I say it's a current asset. Similarly, let's say furniture fixture. So you've done the entire furniture and the finishing in the office. Again, once you do that, you don't intend that you'll again break it down and sell it off, and again you do the furnishing. So again, that will be used for another 5, 10, 15 years.
Yes.
Building that you've made, long term. Warehouses
Yes.
that you have, the factories that you have, that's long term. So if it's
Long term.
long
Yeah.
term, it's non-current. But the stock
Non-current
that you
asset.
produce, let's say you are Ambuja Cement, produce cement. Now, are you intending that you will produce that cement and keep it in a godown for the next 10 years, or your intention is to produce and sell it off immediately and get cash?
Sell it off immediately. That is how it is.
You're holding it for short term. So maybe it will
Short
be in
term.
the godown for maybe a week, 10 days, 1 month, 2 months, but no, you'll not be holding it in your godown for the next 5 years, 10 years. So it's held for short term. It's a current asset.
Okay.
Similarly, the cash that you have, it will keep coming in, going out. So again, it's short term. So it's a current asset. So anything which is short term, current asset, anything which is long term, non-current asset. So I just split it on the basis of the life with the intention for how long I will use it. And then I say whether it's current or non-current.
So in such a case scenario, I could say like my what do you call So my cash flow will always be as
Current.
it'll be current. Okay.
Because I mean, tell me, the 100 rupees that you have in your pocket, the same 100 rupees, are you intending that no, that
No.
100 rupee will be there in your books for the next 5 years? No. I mean, that 100 rupee note could go out, you could get another 200 rupees or 500 rupees. So money will keep coming in and going out. So
Yeah,
it's
yeah,
a
that's
current asset. It's held for
Yeah.
short term.
got it, sir. Got it. Yeah. You can carry on.
Another question was, how is appreciation or depreciation accounted? We'll come to that, don't worry. So we'll capture that when we move to tangible asset. First, any doubt with the broad categories: tangible, intangible, capital work in progress, other non-current assets? We'll look at what is tangible, intangible, capital, and this. But there are 4 categories: that's tangible, intangible, capital work in progress, and other non-current assets. Let's look at what is a tangible non-current asset. So I'm looking at the categories of non-current asset. A tangible non-current asset is something which you can touch, feel, and see. I can touch computers, furniture, fixture, land and building, property, warehouse, all of that I can touch, feel, and see. So that's a tangible non-current asset. Now, when you use these tangible non-current assets, then what happens is their value goes down. And if their value goes down, then I have to reduce it. For example, let's say you bought a car for your CEO. That car was bought for 50 lakhs. You used it for 1 year. The value of the car has gone down to, let's say, 43 lakhs. This reduction in the value of a tangible asset is known as depreciation. So I hope now your question is answered. What is depreciation? So what a tangible asset, a non-current asset. If there is a reduction in that, that is accounted for as depreciation. Similarly, I can have intangible assets. So what are intangible assets? Something which you cannot touch, feel, and see. Typically things like brand name, goodwill. All of that will be your intangible assets, which you cannot touch, feel, and see, but they again help you in running your day-to-day business, generating revenue. Because if you have a brand name like Coca-Cola, or if you have a goodwill in the market, then accordingly you can expand your market. You can charge a higher price to the customer. For example, Apple will sell a product at a premium price, and people are ready to pay exorbitant amounts for the product because of the style quotient, brand name, goodwill, whatever you want to call it. So these are intangible assets. Along with that, company could have a capital work in progress. What's a capital work in progress? A capital work in progress is a non-current asset which as of now is not complete. For example, let's say I'm making a factory. The factory will take 3 years to complete. So at the end of the first year, I've just completed, let's say, 40% of the work. So as of today, I will not show it as a factory as a part of a tangible non-current asset. I will show as a part of capital work in progress. But at the end of the third year, when the factory is ready, I'll transfer it from capital work in progress to a tangible non-current asset. So capital work in progress is an asset which is not yet ready for use, but over the next few years or maybe sometime it will get ready. And once it's ready, you move it to a tangible non-current asset. Patent will be an intangible. So patent, know-how, copyrights, brand name, goodwill, all of that is intangible. So they help you in expanding your business, generating revenue, increasing your profits, but you cannot touch, feel, and see that. Yeah. Any doubt with tangible, intangible, capital work in progress before we look at other non-current assets? Okay. Can we give a monetary value to intangible? Yes, there is a monetary value. Otherwise, if there is no monetary value, you cannot account it in your books. For example, like I said, employee is the biggest asset for an IT company, but because you cannot assign a proper value, you don't show it in your books. And not show it in your books. So goodwill, patent, all of that will have a value, and accordingly you show it in your books. That value is shown in the books. Is there an intangible which will depreciate? Now, when an intangible value goes down, you don't call it depreciation, you call it amortization. So the meaning is the same. When a tangible asset value goes down, you call it depreciation. When an intangible asset value goes down, you call it amortization. So depreciation, amortization is nothing but writing off the value of the asset If it's tangible, you call it depreciation. If it's intangible, you call it amortization. Yep. So on intangibles, you'll not have depreciation, you'll have amortization. Car is tangible. Can you touch, feel, and see the car? Yes. So it's a tangible asset. It's not an intangible asset. Okay, now how do we calculate amortization? Fine, I'll just briefly explain, not getting into the nitty-gritties of an accountant, how you do that. Let's say I've got an asset, let's say goodwill. I feel that this will give me benefit for the next 5 years. So this is year 1, 2, 3, 4, 5. And I've got goodwill worth 500 crores in my balance sheet. So I'll say, okay, I've got goodwill worth 500 crores in my balance sheet. This goodwill will give me benefit for the next 5 years. What I will do is I'll write off this goodwill over the next 5 years. So each year I'll write off 100. So I'll write off 100. So at the end of the 4th year, my goodwill will become 400. Then again, I'll write off 100. Goodwill will become 300. Then it will become 200. Then it will become 100. At the end of the 5th year, it will become 0. So, but when you write off goodwill, that's an intangible asset. You say that I'm amortizing goodwill. You don't say I'm depreciating goodwill. You say I'm amortizing goodwill. Okay. Danish, you said health insurance package from companies are intangible assets for them. For whom? For the company who has taken the health insurance package, or what? No, for me, it's an expense because I'm taking a health insurance package. Let's say I'm ICICI, or maybe let's say I'm Reliance, and I take a health insurance package for my employees from, let's say, HDFC. So when I take it, it's an expense for me. So I'll show it as an expense because I'm paying the money and this is for the benefit of the employees. So this will be a part of my employee benefit expense or whatever it's. It's an expense for the company. FD is an asset. So if I'm looking at FD, FD is an asset and you will show it on the asset side. Again, whether it's long term or short term, if it's long term, show it as a part of non-current asset. If it's short term, show it as a part of current asset. Okay, how do we quantify brand name or goodwill in terms of capital? Okay, how do we capture goodwill? Now, your own goodwill will never come in the books. The only goodwill that comes in the books is when you acquire a company and you pay a premium. So let's say I look at a company like Coca-Cola. And let's say Coca-Cola has acquired another company which was worth 100 crores, but Coca-Cola was ready to pay 120 crores because they felt that if I acquire this company, I will get additional benefits worth 20 crores. So that company was worth 100, but because you acquire that company, your market share will increase, or maybe competition will go down, or you'll get access to some technology or whatever it is, because of which you feel that you'll get benefit worth 20, and therefore you are ready to pay 120 crores. So this difference between 120 and 100 is known as goodwill. So goodwill is like a plug variable. So whatever is the value of an asset, and if you pay a premium for that, that amount is known as goodwill. And this goodwill will appear in your books. Your own goodwill doesn't appear in your books. Okay, question, basically investment policies will count as assets. Yeah. So whatever investment I'm doing, that will be an asset for me. Mediclaim policy, that's a short term. So it will be a part of expense for me if I've taken it for 1 year. But if I've taken it for multiple years, so let's say I've taken a Mediclaim policy for 5 years at one shot. So I'll say for the first 1 year, I'll treat it as an expense. For the balance 4 years, the money that I paid, that's an asset for me because I've paid the, let's say the premium in advance. So that's premium which is paid in advance, that will be an asset for me. But the premium for the next 1 year, I'll take it as an expense because that will give me benefit only for the short term. We'll cover that when we come to the income statement. Then let's look at other non-current assets. So I could have other non-current assets. For example, let's say I've done some long-term investment. And this investment, so let's say I've done an FD. And this FD is for 5 years. So it's a long-term investment. I've bought bonds of the government of India, a 10-year government bond. So again, that's a long-term investment. So that will be a part of other non-current assets. So non-current assets could be tangible, intangible, capital work in progress, other non-current asset. Okay, for a hedge fund, again, if I'm looking at a hedge fund, these hedge funds again will be operating from their own offices. So provided they have not taken these offices on rent. So again, if I'm looking at, let's say they have their own offices, so this building will be a non-current asset. The furniture fixture will be a non-current asset. The laptops, desktops will be a non-current asset. All of that will be a non-current asset. Those investments that they do in different companies, if it's short-term, current, if it's long-term, non-current. The cash balance that they have, that's a current asset. Okay. For example, let's say maybe if I'm looking at a company like, let's say maybe Yahoo. So if I look at a company like Yahoo, then Yahoo, when Jerry Yang around 20-25 years back did investment in Alibaba and Yahoo Japan, he invested somewhere around 5 billion. Now today that value in Alibaba is around 40 billion, and in Yahoo Japan, of course, they've sold that stake in Yahoo Japan, but let's assume hypothetically that is somewhere around 17 billion. So today it is worth 57. So he invested 5, but today that value is worth 40 and 17. Put together, that's 57. But this is a long-term investment. So he did not do the investment for short term, saying that, okay, I'll buy the stake in another company and I'll sell it off, let's say in the next 6 months or 9 months or whatever it is. It's a long-term investment that he's done. Yep. Let's look at current assets now. So we looked at non-current assets and we said non-current assets are of 4 categories: tangible, intangible, capital work in progress, and other non-current assets. Now let's look at current assets. Current assets are those assets which are held for short term. So this will typically include things like cash and bank. It'll include things like your stock. It could be raw material stock, finished goods stock. Then it will include your customers, that's your debtors from whom you have to get your money back. You've paid rent in advance, so that's a prepaid expense. So all of that will be a part of your current assets. So again, the list is used. I'm just giving you typical examples that you'll find in a company. So you'll have cash, bank, stock, debtors, bills receivable, prepaid expense, all of that, all of this will be your current asset. Maybe you've done some short-term investment, so that short-term investment will again be a part of your current asset. So any doubt for the asset side, be it long-term, short-term, that's non-current and current, be it tangible, intangible, capital work in progress, other non-current asset. Yep. Any questions on the asset side before we move to the liability side and the shareholders fund? Okay. And let's look at the shareholders fund. Well, like I said, shareholders fund is what belongs to the shareholders, and it will basically consist of share capital and the profit and loss, which typically is known as your reserves and surplus. So first, let's look at share capital. Share capital could be either equity share capital or it could be preference share capital. So either you could have equity shares or you could have preference shares. Anyone who can tell me what's the difference between equity shares and preference shares? Anyone? Yep. Difference between equity shares and preference shares. Preference shares are offered to select investors, equity now. Okay. Anything else? Anyone? Equal distribution of money to all companies. Preference is some preferred companies you want to invest more. No. Okay. So let's look at it. So I could have two categories of share capital. One is equity, one is preference. When I'm looking at a preference share capital, what's a preference share capital? Preference share capital or preferred shares are those shares where they get a preference over the equity shares in terms of what? In terms of dividend. And when the company is going for liquidation, then they'll get the money first. So whenever a company declares a dividend is nothing but a return that's given to the shareholder. So whenever you want to give a return to your shareholder, the company will first pay dividends to the preference shareholders, and then dividends can be given to the equity shareholders. So preference shareholders will get the return first. Similarly, if the company is going for liquidation and all your assets are being sold off, whatever money is left, that will be paid off to the shareholders. So first, money will be given to the preference shareholders, and if some money is left, then that money will be given to the equity shareholders. So preference shareholders have preference in two terms, in terms of dividend and when there is liquidation. And of course, equity shareholders have their own benefits. They are the ones who actively participate in the day-to-day operations. They are the ones who go for the AGMs and they have the voting rights, so on and so forth. Preference shareholders can also get voting rights, but that's a rare situation. But you have the equity shareholders which have the voting. Again, okay, how do you become a preference shareholder? See, it depends whether the company is issuing preference shares or not. For example, if I look at, if I'm not wrong, JSW, Jindal Steels, this company has both equity shares and preference shares. So if a company is issuing preference shares, you can buy preference shares. But if the company is not issuing preference shares, then I cannot go and tell them, no, you have to issue preference shares because I want to become a preference shareholder. So if the company is issuing preference shares, you can buy it. If the company is not issuing it, they'll just issue equity and you will have to be an equity shareholder. ESOP will not be a part of preference shareholder. So preference shareholder is a separate category. So that's not a part of your ESOP. ESOP is employee stock option plan, which is a right which is given to an employee today, saying that, okay, today the share is trading at, let's say, 2000. But because you are an important employee, you're a part of the top management, I want to retain you. I give you a right that you can buy this share, let's say, for 500. So I'd say that, okay, you buy the share for 500. Today that stock is trading for 2000, which means indirectly I'm saying that, see, as of now only, you get a profit of 1500. So it's a retention strategy which is adopted by a lot of companies, and all of this started typically in the 90s. So 90s was an era where a lot of IT companies, tech companies started issuing ESOPs. A lot of startups now follow that because they want to retain employees, but they may not have a lot of cash to be paid. So they have all those promises that the company will do well in future. So you get a stake in the company, you have ESOPs, and you can exercise them in future and increase your wealth. Like I said, who's a preference shareholder? A preference shareholder is the one who has preference shares. So if you're having preference shares, you are a preference shareholder. If you have equity shares, you are an equity shareholder. And whether you can become a preference shareholder or not will depend upon whether the company is issuing preference shares or not. Okay, question: equity shares have more rights or preference shares? Of course, equity shares, because equity shares have the voting rights. Preference shareholders do not have the voting rights. So they do not actively participate in the day-to-day operations. Equity shareholders have the voting rights. So let's say if you're a shareholder of maybe let's say Tata Motors. So as a equity shareholder, you will have voting rights. But let's assume hypothetically that Tata Motors issues preference shares, which they don't, then you will not have voting rights. Okay, so you have two types of shares: equity shares and preference shares. Now you also have something which is known as DVR, which is differential voting right. Any idea what's a differential voting right? Or any company where you feel that these shares have been issued differential voting rights, DVRs? DVR is a differential voting right. Yeah, anyone? Tata Motors. Tata Motors has two classes of shares. So as the name suggests, differential voting rights. So these shares have different categories of voting rights. So if I'm looking at a company like Tata Motors will have normal shares and they also have DVRs. So let's assume hypothetically that a normal share, one share will give you one voting right. But let's say for a DVR of Tata Motors, let's assume hypothetically that 10 shares will give you 1 voting right. So a DVR is where the voting rights are different compared to a normal share. And it's not just in India, but even globally, if you look at it, a lot of companies have done that. For example, let's look at Facebook or Meta. Like I said, they have normal shares and they have a separate category of shares, that is DVRs, because of which Mark Zuckerberg has only 13 to 14% stake in the company, but it gives him 57% of voting rights. So if you're looking at a company like Facebook or Meta, you clearly know who calls the shots, who takes the decisions. It's Mark Zuckerberg. He's got 57% voting rights. It's not shareholders like you and me. So any company which has DVRs, be rest assured that the power is tilted and skewed in favor of the top management. Prices are different. Definitely the prices will be different. The prices will not be the same. Again, going back to, let's say, a Tata Motor share. Now, I've got shares over here, which is normal shares, and I've got a DVR. Normal share, which has a higher voting right, normally will trade at a higher price. A DVR or a share which has a lower voting right will trade at a lower price. So there's a price difference. You want a voting right, you want an additional benefit, you want to actively participate into the operations of the company, go and participate in AGMs, then you pay a higher price. You have less voting rights, you pay a lower price. Again, maybe let's say look at a company like Ford Motors. Ford Motors, again, look at the Ford family. The Ford family would have, again, let's say 15% or 10% of the stake in the company, but that will give them voting rights to the extent of 30-35%. Look at a company like Google. Google has 3 classes of shares. Anyone who can tell me which are those 3 classes of shares that Google has? I've already said that they've got 3 classes of shares. Which are those shares? Anyone? If I'm looking at a company like Google, I've got 3 classes of shares. They name it as A class, B class, and C class shares. So initially, when Google came out with their IPO, if I'm not wrong, they came out with their IPO in 2004. So when they came out with their IPO, they had only 2 classes of shares, which is A class and B class. And if you look at A class shares are held by normal investors like you and me, where 1 share is 1 voting right. But if you look at B class shares are held by the promoters and the top management. So Page, Brin, and all these people and the top management, they will have B class shares where 1 share is 10 voting rights. So again, it entirely said a different story, that the power is tilted in favor of the top management. As a normal investor, it becomes extremely difficult for you to go against the top management. So A class shares have 1 voting right, B class shares have a higher voting right, and C class shares, 1 share has 0 voting rights. So they have 0 voting rights. And this, they came out somewhere in 2014 or 15. So somewhere in 2014-15, they issued a C class share where they said 1 share will have 0 voting rights. Yep. Jibin, what's your question? Whether the company has the right to change a shareholder from dividend to equity? Dividend to equity means what? Yep. Can you just be a little much more clear from dividend to equity? A preference shares, no. See, if I have equity shares, so let's say I'm X and I've got equity shares, I'll be an equity shareholder. If I've got preference shares, I'll be a preference shareholder. I cannot move from preference to equity unless and until I buy equity shares, or I cannot be a preference shareholder unless and until I buy preference shares. So I can't do that. So whenever you look at a company and you're analyzing a company, always go through their financials and see whether the company has different classes of shares. If they've got different classes of shares, I mean, be a little skeptical about the corporate governance issues in this company, and whether, as retail investors, can we ever influence or change the decision of the top management? Because the top management will have little stake, but they'll have a lot of control on the companies. Like I said, for Facebook, Google, Ford, all these companies, this is what happens. Okay, Nilesh is saying that he's not clear about preference shares and DVRs. Nilesh, preference shares is a different category, DVR is a different category. Okay, so companies generally have equity shares. So I'll just write equity shares, and they've got preference shares. So equity shares are the normal shares which are there in the market, where normally one share will have one voting right. Preference shares, they get preference over the equity shares in terms of what? In terms of dividend, in terms of liquidation. When companies are issuing DVRs, that is differential voting rights, we're basically talking about these equity shares. So equity shares, normally one share is one voting right, but then there could be a company which has different classes of equity shares, where they could say, I've got an A class share. For example, Google has an A class share where one share is one voting right, B class share where one share has 10 voting rights, and a C class share where one share has 0 voting rights. And B class shares are held by the promoters, A class and C class are held by normal investors and the employees. Okay. I mentioned shareholders fund will be a part of profit and loss. No, profit and loss is a part of shareholders fund. So shareholders fund is not a part of profit and loss. Whatever profit and loss that the company earns, that will be a part of shareholders fund because it belongs to the shareholders. Okay. Got a question for different types of shareholders in a loss. Will they have to pay the company in a loss instead of getting no dividend? No, you don't pay the company. So let's say if it's a profit, the company gives you dividend. If it's a loss, the company may not give you dividend, but you're not expected to pay additional money to the company. No. Once you have paid the initial amount when you acquired the shares, you're done. Then the company will not come and say, okay, we are a loss making entity, you pay additional money. No. So that's not. So let's say Tata Motors, I think they came out with the results a few days back and they had losses. Of course, the losses have gone down, but still they had losses. Now the Tata Motors will not come and tell me, if I'm a shareholder, because I have losses, you pay me additional money for me to for them to compensate that loss. Abid, we started at 10:30. We did not start at 9:30. I'll give a break, don't worry. So I'll give a break. Just wait for another 5-10 minutes, then we'll have a break. Yep. Okay, you had a test since 9:30. Okay, fine. Okay, then we'll take a break and then we'll resume at 11:50 then. Okay, we take a break and then let's resume at 11:50. Okay, fine. Okay, class. So we'll resume at 11:50 then. We are taking a break now. Okay, let's resume. So what we've done is we've looked at the shareholders' funds, and we said that it will consist of your share capital, and it will also consist of reserves and surplus. So reserves and surplus is basically the profit or the loss that the company is making, and whatever profit or loss that the company makes ultimately belongs to the shareholders. So let's say I've got share capital of 10,000 crores. I have a profit of 500 crores. So the total amount, which is 10,500 crores, will belong to the shareholder. So that's my shareholders fund. Now, one thing that we need to discuss over here is that when you're looking at your share capital, that is this one, you could have authorized share capital, you could have, and then you have something which is known as a paid up capital. So you have authorized share capital, issued capital, and paid up capital. Anyone who can tell me what is authorized capital? What do you mean by authorized capital? Yeah. Anyone? What is authorized capital? Initial money, no. Invested money, no. Anyone else? What's an authorized capital? Ownership, not exactly. Okay, fine. Let's look at it. So let's say I'm a company. Let's take a hypothetical example of, let's say, Reliance Industries. So let's say when I start my company, I will decide the maximum amount of capital that I can raise from the public. So authorized capital is the maximum capital that you can have in your balance sheet. So let's say Reliance, when they came out with their IPO in the 70s, they felt that they should have a capital of 1 lakh crore. That's the maximum capital that they can have, 1 lakh crore. Now, this is the maximum capital that you can have. You don't need 1 lakh crore as of today. So let's say you issued only 20,000 crore, 20,000 or 20,000 crores today. Now, out of this 20,000 shares that you issued to the public, it's not necessary that everyone will pay the money. There could be some shareholders who default, they don't pay for whatever reason. Either they are having some financial issues, or there is some back end problem because of which the money doesn't get transferred into the company's account. So finally, what happens is the company receives, let's say, only 19,800 crores. So this is what will appear in the balance sheet of the company. So company will say that the amount of money that I've received from the shareholders is 19,800. So this is what will come in the company's balance sheet. But at the same time, the company will also say that I can raise up to 1 lakh, and I had issued shares worth 20,000, out of which I've received 19,800. So any doubt with authorized, issued, paid up. Authorized is the maximum amount that you can ever have as a company in your books. Issued is what you issued to the public, and paid up is what you got from the public. Okay, fine. Then let's look at the liability part. How is authorized capital set? Again, the management will come together and decide. And it's not necessary that once you decide the authorized capital, you cannot change it. So let's say today you feel that 10,000 crores is more than enough, and this would be an upper limit, and this will be your authorized share capital. But over the next 20 years, you've grown to such an extent that you already have shares worth 9,900, and you feel that you will be issuing more shares. Then in that case, you can revise this limit. So you have to go to the ROC, which is Registrar of Companies, uh, get the documents filled in, pay the necessary fees, and you can change the limit. So from, let's say, 10,000, they can change it to, let's say, 25,000. So once this limit is decided, it doesn't mean that it's final. You can change it as and when required. No, see, when I'm looking at an IPO, in an IPO, I'm basically trying to say what are the shares that I'm trying to issue now. Authorized is what is the amount of shares that I can ever issue, not just now. That's an initial public offering, but even in future, when I come with an FPO, it could be FPO 1, FPO 2, FPO 10, whatever it is. So total amount of money that I can ever raise from the public. So let's say my initial IPO is worth only 1,000 crores, but I've said that my authorized share capital is 20,000 crores. So this is the IPO amount. Then after 10 years, I come with an FPO, which is, let's say, 14,000. So I'm still within that limit of 20,000. The company doesn't have a problem. But if the company feels that no, even after this, they'll come up with another offering, and that offering will be another 20,000, then they'll have to revise this limit and they'll have to file the necessary documents, pay the fees, and revise the authorized share capital. Okay, then let's look at the liability side. So if I'm looking at my balance sheet, I'm done with assets. So we looked at non-current assets and current assets. We looked at shareholders fund. Now let's look at the liabilities. Liabilities could be again either long-term, which is non-current liability, or it could be short-term, which is a current liability. So let's say if I'm looking at a typical company, maybe a company like maybe Asian Paints or whatever. So if I'm looking at non-current liabilities and I'm looking at long-term liabilities, typically what you'll have over here is borrowings. So you've taken long-term loans, you issued bonds, debentures, which will be redeemed after 1 year. So let's say you issued a bond for 5 years, 10 years, so on and so forth. And when you take these long-term loans, these are typically secured. So you have to give some sort of a collateral or a guarantee. So that's backed by an asset. So that in case you default, the banker can sell off that asset and recover the money. A typical example would be, let's say, when you go and take a home loan, the banker says, okay, I'll give you the home loan, but the collateral or the guarantee would be the house itself. In case you default, then the banker can sell off the house and recover the money. So these long-term borrowings or long-term loans are typically secured. You give some sort of a collateral or an asset for the banker's safety. Then you could also have other non-current liabilities. And when I'm looking at other non-current liabilities or long-term liabilities, maybe again, let's say if I look at a company like, let's say, Asian Paints. So for an Asian Paints, other long-term liability could be the dealer deposit. So let's say you want to become a dealer of Asian Paints. So you'll have to give some deposit. You enter into an agreement with Asian Paints, and that agreement is generally for more than a year. So this deposit that you give, whatever hypothetical number, let's say it's 1 crore, 2 crore, 5 crore, 10 crore, whatever it is. So that is a deposit that is given to Asian Paints. And as and when the contract is finally cancelled or it gets over, this amount of money will be given back to the dealer. So again, it's a liability for Asian Paints, but it's a long-term liability because you'll not pay off the money to the dealer, let's say in the next 6 months or 1 year. So again, it's a part of other non-current liability. Then you could have things like, let's say, gratuity. So because gratuity is something that you pay to your employees after they complete, let's say, 5 years in the company, let's say pension funds, all of that. All of this will be an example of other non-current liabilities. Again, something that you have to pay after 1 year. So any doubt with non-current liability before we look at current liability? Okay, then let's look at current liabilities. Current liabilities are those liabilities which insurance will come under non-current liability. Again, you're talking from whose point of view? Insurance that you've taken or insurance given? Insurance taken for employees. So again, let's say if I'm a company, it could be either a life insurance policy or maybe let's say a health insurance policy. For me, it's an expense because I'm doing it for the benefit of the employees. And if I take a policy for 1 year, it's an expense. But if I take a policy for more than a year, then whatever amount I've paid as premium for the first 1 year, I'll take it as an expense. whatever premium I've paid for more than a year, I'll treat it as an asset because I've paid the money in advance. The insurance I paid in advance. So let's say you've taken a health insurance cover for the next 2 years because you were getting a substantial discount from that insurance company. So the expense, the premium for 1 year will be shown as an expense. The premium for the second year will be shown as a current asset because it's a prepaid expense for you. You've paid the insurance premium in advance for your employees. It's not a liability for you. Okay, now let's move to current liabilities. So let's look at current liabilities. Current liabilities, let's say you go and purchase goods from your supplier and you purchase goods on credit. So you'll make a payment after, let's say, 30 days or 60 days. So that supplier becomes a current liability for you. So your suppliers will come here. Then let's say you've taken short-term loans. So all that will come here. Then maybe you have some amount payable. So let's say electricity bill payable, taxes payable. So all of that, electricity outstanding, tax outstanding, dividend outstanding. So anything which is outstanding and you have supposed to make a payment for that in the next 1 year, that will be a part of current liability. So any doubt with the balance sheet? So this is your balance sheet. And balance sheet talks about the asset position, the liability position, and the shareholders position. And balance sheet is made as on a particular date. So let's say it's made for, let's say, 31st March 22. So I'll say, okay, as on 31st March 22, these are my assets, these are my liabilities, and these are my shareholders' funds. And the total of the asset and the total of the liability has to be the same. So if my assets are worth 2 crores, the total of shareholders fund and liability should also be 2 crores. So it has to balance, it has to tally. So that is why you call it as a balance sheet. Any doubt with the balance sheet? Okay. Then let's look at how do we link a balance sheet with the life cycle of a company. So just like you have, let's say, the product life cycle. So if you look at a typical product, a product will go through different stages. You'll have the introduction stage, growth, maturity, and decline. So let's say you have the introduction stage, then you have the growth stage, then maturity stage, and finally the declining stage. So introduction, growth, maturity, decline. Similarly, companies also go through this life cycle. So it's a typical corporate life cycle where you'll have companies at the introduction, growth, maturity, and decline stage. Now, when I'm looking at my balance sheet, I would try to look at what happens at these stages with respect to my shareholders fund, with respect to the asset that the company has, and let's say with respect to the debt that the company has in the balance sheet. Okay, got a question. Can you repeat the explanation on how is the balance maintained between shareholders fund and liabilities? Are you talking about this 2 crore and 2 crore, or are you talking about the shareholders fund and liability? Or are you talking about this 2 and 2? Yep, Danish. 2 and 2, fine. Now, it will automatically balance. You don't have to do anything because the name itself suggests that, let's say I take a hypothetical example, I've taken a loan. So when I take a loan of 10 crores, then on one side I'll have a liability, on the other side I'll have cash of 10 crores. So my balance sheet will tally. So you don't have to do anything unless and until you made a blunder, your balance sheet will not tally. Otherwise, your balance sheet will automatically tally. Let's say this cash is used to buy a machine. So I buy a machine worth 10 crores. So again, asset side will be 10 crore, liability side will again be 10 crores. So total of the liabilities and the shareholders fund will be equal to the total of the asset side. That is why you call it as a balance sheet. It has to balance. Okay. Now let's look at the life cycle. Let's look at shareholders funds. Now tell me, at the introduction stage, you're a young company, you're a startup. what will be your shareholders fund situation, which means share capital plus reserves and surplus? Will it be a positive number, a negative number, and why? Shareholders fund, if you are a small company, a young company, a startup, shareholders fund, positive, negative, why? Yep, anyone? Shareholders fund. Anyone from the batch? Positive, as you've just started, positive initial investment. I'm looking at shareholders fund, which consists of share capital and reserves and surplus. Shareholders funds will typically be negative. Why? As a startup, typically what will happen is you'll raise money from your friends, relatives. So the share capital will not be substantial. It will be a small amount of money. But your expenses will be more compared to the revenue that you're generating. So you'll have a lot of losses. Share capital will be less. And when you add share capital and your losses, you'll end up generally getting a negative number. So at the initial stages, you will end up having a shareholders fund which is negative because of the huge losses that you have at the initial stages. Slowly and steadily, as the company moves from the introduction stage to the growth stage, those losses will slowly and steadily turn profitable. This is the stage when you come up with your IPOs. So your share capital base also increases. You move into a profit zone, and therefore, what will happen is then you will have a positive number. Any doubt with this? With the shareholders fund? Okay. As a young company, let's say you started your company just 1 year back. So what you've done is you've started your company with your own savings. You've told your friends, relatives, parents to invest some money, and you've given stake to them. And maybe let's say you started with an investment of 50 lakhs. So you started with an investment of 50 lakhs. Now you've got a share capital of 50 lakhs. But initially, what will happen is you'll have very little sale, but you'll be incurring expenses, especially the fixed costs. So you'll have to pay the rent, you'll have to pay salaries to your employees. All of that has to be done, whether you generate any revenue or not. So generally, what will happen is you will end up making a loss because your revenue will be less and your expense will be more. And the chances are that this loss will be more than your initial amount that you invested in the company, that's share capital, and therefore your shareholders fund will be negative. So as a young company, a startup, your shareholders fund would generally be negative. But as you grow, those losses will turn into profits. You issue shares, you go public, you come up with an IPO, that's initial public offering. So your share capital will increase, losses will go down, and therefore that shareholders fund will become positive. Then at the maturity stage, it will again be positive because let's say your profits will balloon and your reserves and surplus will keep increasing. So again, the shareholders will be a positive number, and here it will be a big positive number. So in the growth stage, it will be a small positive number. Maturity stage, it will be a big positive number. What will be the situation in the declining stage? Anyone? To your shareholders fund? What will happen to your shareholders fund if you move into the declining stage as a company? It will decrease because what will happen is slowly and steadily you're losing out on the market share. Customers don't want to buy your products or they don't like your services. So again, your revenues will start going down. Finally, they'll reach to such a level where you end up making losses, and then your losses will become more than your share capital, and slowly and steadily it will again turn negative. So maybe at the initial stages it will still be positive, but slowly and steadily as you move further, it will turn negative. Okay. So any doubt with the shareholders fund? You start with a negative number, move to a small positive number, then a big positive number, and then slowly and steadily again it will move to a negative number. Any questions on the shareholders fund before we look at the asset position and the debt position? Debenture is nothing but a debt. So debenture is a bond. So let's say when typically governments issue, then they call it as a bond. When companies issue, they call it as a debenture. So let's say I'm Reliance Industries and I want to raise money. I want to take in terms of debt, but I don't want to go to a banker and take a loan. So what I'll do is I'll come to you or the public in general and I'll say, okay, are you interested in giving me a loan? And I'm ready to issue you an instrument where I'll give you an interest of 10%. So let's say you give me 100 rupees and I'll give you interest of 10% for the next 5 years. And at the end of the fifth year, I'll also give you back your 100 rupees. So that's a debt instrument, which is typically a debenture. Okay, is there a general trend or for startups? Again, I'm saying generally startups will have negative shareholders funds. Of course, it could be a rare situation where a startup is also profitable, but that's a rare situation. So generally shareholders fund will have, startup will have a negative shareholders fund, and slowly and steadily they'll move into a profit zone. Okay, then let's look at the asset position. Let's look at the asset base. As a young company, as a startup, you've just started your business. What will happen to your asset base? Will it be a big number or a small number? Will it grow at a fast rate or a slower rate? What will happen? It will be a small number because you don't have a lot of cash, you don't have a lot of money, so you can't buy assets worth 1,000, 10,000 crores. You'll have assets worth maybe 10 lakhs, 50 lakhs, maybe 1 crore, depending upon the amount of money that you have. So asset base will be small. But this asset base will be increasing at a very fast rate. So let's say in the first year you had assets worth, next year you could have assets worth 25 lakhs. So you could be expanding your asset base at 100, 150%, 200%, 300% year on year at the introduction stage when you're a small company. Slowly, when you move to the growth stage, again, because you're growing, so your asset base will increase, it will go up. So it will be a bigger number, but the growth rate will slow down. So you'll not be expanding your asset base at 100, 200, 300% year on year, but it could be expanding at, let's say, 40, 50, 60% year on year. So you'll be expanding, your asset base will become bigger. You'll not have assets worth 5 lakh, 10 lakh. You'll have assets worth, let's say, 1 crore, 2 crore, 10 crore, 100 crore. But you will not move from 100 crore to 200 crore over the next 1 year. Maybe you'll move from 100 crore to 130 crores or 140 crores next year, then from 130 crores to maybe 150 crores next year. So asset base will become bigger, but the growth rate will slow down. Then as you move from growth stage to the maturity stage, the asset base will be at its peak, because that is when you have your market share in place, you have your customers in place, everything. So your asset base is the biggest. But then the growth rate will be abysmal. You will be expanding your business at maybe, let's say, 2%, 3%, 5%, so on and so forth. You'll not be expanding your business at 30, 40, 50%. So you don't go and you don't keep on setting up more and more factories, because you already have a market share, and then you find it difficult to increase that market share year on year by 30, 40%. So you are a mature company. So asset base will be the biggest, but the growth rate will be abysmal, very little growth. What will happen at the declining stage to your asset base? If you're a sensible company, what should happen to your asset base? Okay, I've got an answer. Sell off, remain the same, less. Okay. If you're a sensible company and you're at the declining stage, which means you're trying to tell me that your customers don't like your product, they don't like your services, slowly and steadily, what should typically happen with a sensible company? You should shrink your business. You should start focusing only on those businesses which are profitable, where you have the market share, and you should try to get rid and move out of those businesses where you're losing out on market for whatever reason, maybe competition, maybe government policy, whatever it be the case. But you should start focusing only on the main profitable businesses. So slowly you will start selling off your assets, you'll start shrinking your business, your business will become smaller. So it will start going down. So I'm just putting an arrow and I'm saying that it will start going down. So any doubt with the asset situation? So you'll start with a small number, but this number will be growing at a very fast rate. Then you move to the growth stage, it will be a bigger number, growth rate will slow down. Maturity stage, you'll have the biggest asset base, but you'll hardly grow and expand. And at the declining stage, slowly and steadily, your asset base will go down. Yeah. Any questions on the asset base before we look at what will happen to the debt position? Okay, then let's look at debt. If you're a young startup, you've just started your business 6 months, 1 year back, what will be your debt position? You will have no debt, you'll have a lot of debt. What will happen as an initial company? Okay, what an answer. High, high, okay, high debt. Almost zero debt. Leave aside high debt or little debt. You'll have almost zero debt or maybe zero debt. Why? You've just started your business. You're hardly a profitable entity. You're not generating a lot of cash. You tell me you go to a banker and you tell that person, I want a loan of 50 lakhs, 1 crore, whatever it is. Will the banker fund you? You go and tell the banker, today I'm making losses, but my future looks good. The banker will give you a simple answer, then come 2 years or 3 years down the line and we'll discuss it later. The banker is hesitant because today you are not generating cash. How will you repay the loan? He cannot give you cash today or a loan today with the expectation that you will do well in future. You're like taking a loan today. How will you repay the loan if you're not generating cash? So he'll say, okay, fine, your profit, your business looks good, but then as of today, you're not generating cash. Maybe 2 years, 3 years down the line, when you start generating cash, you turn into a profitable entity, then we can discuss it and we'll take it up further. So maybe you'll have zero debt or very, very, very little debt. Okay. Then as you move from the introduction stage to the growth stage, then you start then you move from a loss making entity to a profitable entity. This is where your loan taking appetite opens up. So this is where you can go to a bank, negotiate with the bank and say, now I'm a profitable entity, would you be interested in sanctioning the loan? The banker would give the loan, but then again, he'll not give a big loan or a big quantum of loan. Small chunks of loan could be given to you. So little bit of debt would be there at, let's say, the growth stage. At the growth stage, you'll have a little bit of debt. But as you move from the growth stage to the maturity stage, this is where your debt taking appetite just opens up. You go to a bank and you tell the bank, I'm the world's most profitable entity. There's no competition which I have. Are you ready to sanction the loan? In fact, the banks would be running behind you and say, sir, are you interested in taking a loan? Do you mind taking a loan from my bank? That bank is giving you a loan at 10%. We are ready to give you a loan at 9.9%. So this is where you start taking more and more of debt. You will try to replace expensive debt with cheaper debt. So this is where the debt would be at its peak. And then finally, at the declining stage, again, if you're a sensible company, what you should be doing? Okay, Abid has raised his hand. Yep, Abid.
So how would we, say the loan of a cash credit given by the bank? So here the bank is a business partner or how's it?
If you're looking at a cash credit, that's basically what you're talking about is a loan given for your day-to-day operation. So when I'm talking about debt, I'm not
So
talking
what
about
is
the
it exactly?
short-term debt.
It comes in the
I'm
loan
talking about
or?
it's a loan, but it's a short-term loan. So this loan basically that we're talking about is a long-term loan. So I'm not talking about your CC limit or an OD limit, which the banker gives you for your day-to-day operations. No, that definitely the banker will give. That is not a problem because you have to run your day-to-day operations. For your day-to-day operations, you could go to a banker and say that the banker could be giving it to you. That is your working capital loan. Long-term loans, the banker will be hesitant. They are not ready to give you loans for 5 years, 10 years, 20 years, because as of today, you're not a profitable entity. Yep. Any other question before we look at the declining stage? Okay. Then at the declining stage, if you're a sensible company, what is it that you should be doing as a company as far as your debt is concerned? we would have already paid maximum percentage of debt when at maturity stage and keep less debt towards the end. As a sensible company, you should try to get rid of the debt which is there in your balance sheet. And even if you don't try to get rid of it, the banker will start putting pressure on you and will say, please repay off the remaining debt, because now the banker has lost confidence. He's seeing that your market share is going down, your profits are turning into losses, you're not a cash generating company now. He gets into that fear as to how you would pay off the loan. So he'll start threatening you and saying that, okay, if you don't repay off the loan, I'll start selling off your assets to recover the money, or maybe I'll start the bankruptcy process, or whatever it is, I'll drag you to courts. So as a sensible company, your loan, your long-term debt, and all of that should start coming down. Yep. So this is how companies move through the life cycle. Any doubt with this before we look at real life companies and go through the balance sheet and see what happens at different stages, be the introduction, growth, maturity, or decline? Okay, then let's look at real life companies. So let's say I picked up a company like Peloton. Now, what does this company do? This company basically is into the business of selling expensive exercise equipments, and they came out with their IPO somewhere in 2019, 2020. So it is a small company, and I've taken the annual report for 2019-20. So it was a very small company at that point in time. Look at the asset base. The asset base is extremely small. It's 864. But look at the rate at which it is growing. It is expanding at a very fast rate. So year on year, it is growing at like 300, 400%. The biggest asset for this company is the cash. And why is cash the biggest asset for this company? Because in 2019-20, the company came out with their IPO. So they're still sitting on a huge amount of cash, and that cash is yet to be deployed as far as purchase of asset is concerned. But if I look at, let's say, the shareholders fund should be negative. So if you look at your shareholders fund, it's negative. So you're still a loss-making entity. The next year, why is it positive? It's positive because of the IPO or the share capital or the money that you've raised from the public. But otherwise, you're still a loss-making entity. So initial stages, you'll be a loss-making entity. You'll have no debt, but your asset base will be small and it will be increasing at a very fast rate. So this is what we discussed when we're looking at a young company. Similarly, let's say if I look at maybe a company like, let's say, Netflix. Company like Netflix, it's at the growth stage. So the asset base will be bigger. But if you look at your total assets, from 25.97, they've just gone to 33.97. So they're not increasing like 300, 400% year on year. They'll increase, but they'll increase at a smaller rate. So maybe they'll increase at 40, 50% year on year, not like 300, 400% year on year. And if you look at Netflix, the biggest asset for them is non-current content asset. Any idea what's this non-current content asset? Yeah, anyone? Non-current content asset. These are the licenses or the movie shows and the shows that they get a right to show it. So that's the non-current intangible asset. So those intangible assets, the movie shows, films, and all of that, that's the biggest asset for a company like Netflix. It's intangible, non-current asset. So you look at a lot of these service entities, they will not have a lot of non-current tangible assets. They'll have huge non-current intangible assets. A typical example, Netflix. Then on the liability side, you also have something like a deferred revenue. What is this deferred revenue which is shown under current liability? Any idea? Netflix deferred revenue. Liability, it's liability. So it's not a recoverable. If it's a recoverable, it will become an asset. Now, typically what happens is you go and take a Netflix subscription. So let's say you've taken a subscription for 1 year, and let's assume hypothetically you've paid 1200 rupees, which means you're telling Netflix that, okay, I'm ready to pay you the money today, 1200, and you give me the services over the next 12 months. So from the company's point of view, that is Netflix, the company has received the money in advance, but is yet to render the service. So that's a deferred revenue. So they've got the money in advance, they haven't rendered the service. So it's an obligation for them, and they have to render the service in the next 1 year. So this is the deferred revenue, which is subscription money that they receive in advance. So this is like a company which is typically at the growing stage. Then if I look at maybe a company like, let's say, Coca-Cola. Look at a company like Coca-Cola. Look at their asset base. From 83, they've gone to just 86 over 1 year, which means there's hardly any growth of like 4-5%. So when you're at the growth stage, you don't keep growing at 30-40% also, like Netflix was growing, or maybe Peloton was growing at 300-400%. You grow at 4-5% year on year. But at the same time, you'll have debt, you will have a lot of debt, so a lot of long-term debt is there. And along with that, if you look at this company also has goodwill, which means during this year, Coca-Cola has gone and acquired some other company, and when they bought that company, they paid a premium for that. So they paid premium. So that is how goodwill has come into the balance sheet of Coca-Cola. They also have something which is an equity method investment. So this is long-term investments that they have done in other entities. So it's a part of your non-current asset. And they also have something which is known as a treasury stock. Any idea what's a treasury stock? So Coca-Cola has something which is a treasury stock and it's negative. What does it mean? Government bonds? No. Anyone? What's a treasury stock? Okay, question is, where do we download the balance sheet of different companies? Just go to the company's website. For example, let's say just give me a second. I'll open it for you and share it. So let's say I go to Google and I write Tata Motors. Okay, so I go to Google, I write Tata Motors. So I click on Tata Motors and then I go to investor column. Under investor column, I'll have annual report. So this is where they give me the entire data about their company. So I'll select the year, whichever year's data I want. So let's say if I select 21, 22, then I can select the annual report and then I can download it as a PDF, or maybe if I just want to just have a look at it through the web, then the HTML mode. So if I just go to the PDF, then I'll get the PDF version, and then you can download it and save it wherever you want. Yep. So this is how you can do it. So go to the company's website, go to the investor section, you'll get your annual report. No, share of company with own. Great. What's a treasury stock? Treasury stock is when the company does a buyback. So you're telling me that Coca-Cola has done a buyback. They have bought their own shares. Now the question is, why does the company do that? And especially if you look at a lot of IT companies. So let's say if you look at companies like Infosys, TCS, Wipro, maybe companies like Apple, Google, all these companies, they do a lot of buyback. Why do these companies do a buyback and they buy their own shares? So that buyback that they do is your treasury stock. Yeah, anyone? Increasing their holding. So let's say the company feels that they have a lot of cash, and rather than investing that money somewhere else, they're much more confident about their own company. So they feel that it's better to invest back into their own company and buy shares from the public. So let's say I've got 100 shares of Infosys, and Infosys makes an announcement that anyone who's interested in selling the share, you can sell the share for 4,000 rupees. And I'm not that confident about the future of the company, but the management is. So they are ready to pay 4,000 rupees per share. I've got 100 shares. I'll participate in that. I'll sell my 100 shares and the company will give me 100 shares into 4,000. I'll get the money. So the company wants to increase their stake. They're much more confident about their company, or they feel that the shares are underpriced. They feel that the shares are currently trading at 3,000, whereas the shares should be trading at 4,000. So it's an indirect way of increasing the price, because when you buy the shares, you're creating demand, and then there's an inverse relationship between, let's say, the demand. I mean, there's a direct relationship. So if the demand increases, automatically the price will increase. So once they start buying the shares, the demand goes up automatically, slowly and steadily the price will go up, and it could move from 300 to, let's say, 3,500, slowly and steadily to 4,000, and it could reach the management target, and therefore they're ready to give you 4,000. No, LLC, it's not necessary. So LLC, it's not necessary. So in that case, it's not necessary for them. Okay. Finally, if you look at, let's say, Coca-Cola also, it's a very profitable entity. So if you look at your reserves and surplus are huge. So it's a profitable entity. Asset base is big. It at its peak, and it's not growing at that fast rate. It's growing at a rate of, let's say, 4-5% year on year. Along with this, let's say I've also taken one more company. Maybe let's look at Toyota. So if I'm looking at a company like, let's say, Toyota, if I look at it, it's at the maturity stage, but if it doesn't do a lot of things properly, then slowly and steadily it could move into the declining stage. So it's still in the maturity stage, but look at what they're doing in India. They have a tie-up with Maruti Suzuki, and they use the same platform. They make similar cars. It's just that the badging is different, and a few features here and there could be different. So in India, as far as Toyota is concerned, the biggest seller is the Innova. So they have to come up with something new. Globally, fine, they could still be doing well, but let's say as far as the Indian operations are concerned, maybe they are not doing that much. So if you look at this company, look at their asset base. If I look at their asset base, from 51.93, it has just gone to 52.68. So there's hardly any increase in the asset base as such. At the same time, if I look at the liabilities, the company will have a lot of debt because it's a mature company. So the company has debt, and it's also a profitable entity because you look at the retained earnings, they have a lot of retained earnings. This company also has treasury stock, so they have also done a buyback. So this is how typically companies will move through the life cycle as far as their balance sheet is concerned. Any doubt with the balance sheet before we move to the income statement? Yep. Again, when you're looking at stock and share, it's the same. So some people will just call it stock, some people will call it share. That's it. When do companies decide to reduce debt? Again, see, companies will try to reduce their debt when typically they move towards the fag end of the maturity stage, or they've moved into the declining stage. See, debt is a cheaper source of financing. So let's say if I go and take a loan from a bank, I could get a loan from a bank. If I'm a corporate, I could get a loan from a bank at, let's say, 10%, 11%, maybe 9% also, whatever it is, depending upon my credit rating. But if I issue shares to the public, and the shareholder will not expect 8, 9, 10, 11% in my company, his expectation will be more because he's taking risk. So debt is a cheaper source of financing. Equity is an expensive source of financing. So companies generally will take debt because that reduces their overall cost of capital. But when they feel that no, the business is not doing well, they're losing out on market share, they're turning into a loss making entity, or they could be turning into a loss making entity, a sensible company should be repaying off the debt. Again, the problem is a lot of companies, even in spite of the fact that they've moved into a loss-making zone, they don't repay off the debt. They go to bankers. The banks are hand in hand. Then they sanction more loans to these companies, and ultimately the bubble bursts, and finally these companies have to go for liquidation. So finally, somebody will drag them to NCLT, and the liquidation process will start. Ultimately, the banker will lose, the company will lose, and people like you and me, we lose our money. So I'm saying a sensible company should be repaying off the debt when they see that the markets are not doing well, they're losing out, the market share is going down, so on and so forth. Okay, then let's move to income statement. So let's look at income statement. So a balance sheet shows the assets and the liabilities and the shareholders fund. What does an income statement do? An income statement shows you what is the expense, how much is the revenue, and finally, what's your profit or loss that you have generated. So in an income statement, you talk about what is the total revenue that you're generating, the income that you're generating from sale of goods or services or any other revenue that you're generating, what's the cost that is being incurred to produce those goods, render those services, or to run your day-to-day operations. And finally, the difference between the two will tell you whether you're a profitable entity or a loss-making entity. So if I look at a typical company, what a typical company does is, a typical company, when they're making their, so let's say I'm making an income statement for a company, they will show their sales, then they'll take any other income that they have. So they'll have other income. So let's say sales is 1,000, other income is 500. So finally, they'll say the total income that we have is 1,500. From this, they'll deduct all their expenses. So let's say they've consumed some material. So material cost will be there, labor cost will be there. So employee benefit, wage cost, labor cost, salaries, all of that will come. Then you'll have all your other expenses. So let's say advertising cost, printing and stationery cost, insurance cost, all of that will come, and typically they'll club it together. So let's say put together that is 800. What they get over here is EBITDA. So EBITDA is an earning, but nothing but earnings before interest, tax, depreciation, and amortization. So EBITDA is earnings before interest, tax, depreciation, and amortization. So for this company, it comes to 700. From this, the company will reduce the depreciation and the amortization. Let's say that is 200. Finally, what they get is EBIT of 500. EBIT is earnings before interest and tax. So this is the earning or the profit that the company has generated before paying interest and before paying taxes. From this, the company will reduce interest. So let's say interest is 150. What they'll get is profit before tax. So that is 350. Then they'll pay tax to the government. Let's say that is 50 rupees. And finally, what they get is profit after tax of 300. So this profit of 300 will go to the reserves and surplus, and it belongs to the shareholders. So this is how companies typically make their income statement. They'll take their sales, which is the money that they generate from their day-to-day operations. They'll take any other income that they have, which has got nothing to do with their day-to-day operations. So this will include things like interest received, dividend received. So this is not from their day-to-day operations, but still they're getting some income. Then they'll reduce their expenses, which will typically consist of the material cost, labor cost, and other expenses which are clubbed together. You get EBITDA, reduce depreciation amortization, get EBIT, reduce interest, get PBT, reduce tax, and finally what you get is PAT. Any doubt with the income statement, any part? Yep. Any questions on the income statement? Okay, Abid. Yeah.
What is this? You're deducting after the EBIT.
EBIT, I'm
Before
reducing
interest
interest.
and taxes, you're deducting 150
Interest.
interest. So again, okay.
So this is earnings before interest and tax. So I'm saying before paying interest and tax, my profit was 500. Interest is 150. So what I get is profit before tax. So PBT is profit before tax. So I'm saying before tax, my profit is 350. Then I'll pay the tax, and my profit after tax is 300. So PAT is profit after tax. PBT is profit before tax. Interest earned is a part of income. So when you've done investments, so let's say you've bought some government bond or you bought a debenture issued by any other entity, You will get interest. It's an income for you, and that will come here. It is other income because it's got nothing to do with your day-to-day operations. So you had some surplus cash, you've done some investment, because of which you're generating money. That is other income. Any doubt with the income statement?
Hello, sir. Hello.
Yeah, tell me.
Sir, suppose which one is the better means suppose I am buying a share of any company. I want to check the company's health. So which one is the better option? Means shall I check the EBITDA or the P after PAT?
If I look at EBITDA basically is nothing but like a proxy of operating profit. From this, or sorry, not EBITDA, I should be looking at EBIT because that's operating profit, provided I'll have to take care of other income. So let's say I've got a company which doesn't have other income. So this is not there. So sales is from my day-to-day operations. That's my income from day-to-day operations. Then I take care of my other operational expenses. So expenses which I'm incurring from my day-to-day operations. And finally, I'll be getting something which is known as operating profit. So operating profit will tell you whether the company is fundamentally a strong company or not. From its day-to-day operations, is it generating profit, or is it because of other income that the company is generating profit? So let's say your sales are only 1,000, but your other income is 5,000, because of which you're getting an operating profit or you're getting an EBIT of 500, which means if this income is not there, which is other income, you will become a loss-making entity. So fundamentally, you're not a big, great company. So you should basically be looking at operating profit and not at just PAT if I'm looking at investing in a particular company. Okay, got a question. If there is a loss, should I also calculate EBITDA? Yes, because I finally want to show and tell the public in general what is the loss that I'm generating. So let's say I just change the numbers. So let's say this becomes minus 1,000. So I'm saying, okay, my EBITDA is negative 1,000. On top of that, I have depreciation amortization, which is another minus 200. So I get minus 1,200. Then I'm also paying an interest. So interest I'll pay. So let's say interest is another 150. So I get 1,350. Now, because I'm a loss making entity, I'll not pay taxes. And finally, I'll have a loss of 1,350. So I want to tell the public in general that yes, these are the losses that I'm finally making. So even if I'm a loss making entity, I still have to show my losses to the public. Any doubt with the income statement? So take all your incomes. This is what the companies do, be it whether it's from your day-to-day operations or other income. Take all your expenses, then finally get your EBIT, reduce your financing cost, which is your interest cost, get your PBT, reduce your tax, get your PAT. Do companies forge data? I don't have to say whether the companies do it or not. You know the answer. Do companies do it? Definitely. A lot of companies do it. But of course, if you're a big brand, you'll not try to do that because that will in turn affect your goodwill and reputation in the market. But if you're a small company, you'll try to do it. Look at what happened with Satyam way back in 2008. This is what happened, right? So they had fudged the data, they had done a lot of window dressing, and because of which finally it all came out. And once it came out, finally the promoter and everyone was taken to task. So companies fudge the data, they do a lot of window dressing. So you'll have to be a little careful. Okay, question is it good to show profit or loss? I mean, it's but obvious that you would like to show profit rather than a loss, right? I mean, it's like saying that is 100 crore profit better or a 100 crore loss better? Obviously, it is a 100 crore profit because I'm telling I'm telling the public in general that I'm a profitable entity. I'm generating a profit of 100 crores. So companies again could do window dressing, and they could play around with numbers, and they could just say that okay, I'm a profitable entity, whereas technically it could be a loss making entity. So you have to be a little careful when you're looking at the numbers given by these companies. A profit needs to be shared by the shareholders, but ultimately look at the promoter. Promoter is also a shareholder, right? So at the end of the day, if I'm a promoter, I'm Mark Zuckerberg, and I've got 13% stake or 14% stake. So whatever profit is earned, 13% of that belongs to me also, right? Okay. Then just like we looked at the life cycle of a company and linked it to the balance sheet, we can do the same thing with respect to the income statement. So if I'm looking at an income statement, I'm looking at the life cycle of the company. Again, I could have the introduction stage. I will have the growth stage, the maturity stage, and finally the decline stage. So when I'm looking at the life cycle of a company, typically I'll be focusing on what will be the situation for revenues and whether the company will be a profitable entity and a loss-making entity. So let's look at the introduction stage. If you are a young company, a startup, will you have a lot of revenue or less revenue? What will be the situation as a young company? Revenues are extremely low. It's low revenues. So you'll have some income, but it will be very less. But as you keep expanding, these revenues will start increasing and it'll go up. So it'll become bigger. And here it will be the highest or the biggest. So revenues over here will be highest or biggest, whatever you want to call it, because you're as a mature company, less competition, you're getting economies of scale, your fixed cost is the same, but for every incremental unit that you're selling, you generate more money and more profit. So revenues are at the highest. At the declining stage, you're losing out on your customers, market share going down, and your revenues will start declining. So I'll just write decline. So this will be your revenue situation. You'll start with a small positive number. It will become bigger. Then it will reach the peak. And then again, it will start going down. What will happen to your profit or losses when you're at the introduction stage? Introduction stage, profitable entity, loss-making entity, what happens? Chances are that you'll be a loss-making entity, or maybe a very small amount of profit, but 99% chances are that you'll be a loss-making entity because you'll not have a lot of revenue, you'll still have a lot of cost, and therefore you'll end up making losses. Slowly and steadily, as you move to the growth stage, these losses will turn into profits, but it will be a small positive number. So you'll have profits, but it will be a small number. As you move towards the peak, the maturity stage, your profits will increase and they'll be at the peak, again because of economies of scale and everything. And finally, at the declining stage, again you'll slowly and steadily you'll move into a loss zone. So initially, so at this stage, maybe you could still be a profitable entity, but your profits could be shrinking, your profits could be going down. And as you move more in the declining stage, more towards the end of the declining stage, you'll end up becoming a loss-making entity. Yep. Jyotishman can be both. Yeah, fine. Yeah, fine. It's both. Any questions or any doubt with the life cycle of the company as far as income statement is concerned? Again, if I take you back to the live companies, so if I take you to Peloton, look at Peloton, look at your revenues from 435, they've gone up to 1825. So revenues are small, but they're increasing at a very fast rate. They're increasing like 100%, 150% year on year. But at the same time, you are still a loss-making entity. So you're making losses. So a young company will have less revenues, but those revenues will be increasing at a very fast rate, but you're still a loss-making entity. Compare this to, let's say, a company like Netflix, which is at the growth stage. So if I'm looking at, let's say, Netflix. So if I look at the revenues, look at the revenues are bigger, but look at the growth. They are not increasing like 100 or 150 or 200% year on year. From 11.69 they go to 15.79, then they become 20.15, so they're increasing like 40-50% year on year, but you're a profitable entity, so you move into the profit zone. And finally, let's say if I look at maybe Coca-Cola, then if you look at Coca-Cola, so yeah, so this is the income statement of Coca-Cola. Look at the revenues. From 36 they've gone up to 37 over a span of 2 years. In fact, in the middle the revenues had actually gone down, but on a compounded growth basis over 2 years it has gone from 36 to 37%, which means it's not even increasing at 10%, it's increasing at like 3-4-5% year on year. But you've got huge bumper profits, so you're a very profitable entity. So the profits are at the peak, revenues are at the peak, but growth rate is abysmal. And finally, when you move to the declining stage, profits could slowly and steadily start going down. The profits will turn into negative, your revenues will start going down, and it'll go down. So any doubt with the life cycle of a company and how we link it to the income statement? Any questions on the income statement or the balance sheet? Okay. So, okay. What is more important, growth or profit? Growth is important, but it doesn't mean that when you grow, that growth will be good. So if you're growing at a cost where you're bleeding, it doesn't make sense. But if you're growing where you give returns to your investors, to your shareholders, and it's good growth, then it makes sense. Otherwise, it doesn't make sense if you're just bleeding and bleeding. I can understand that you bleed for the initial few years where you're loss making and you're trying to kill the competition and everything. But somewhere down the line, maybe 10 years or 15 years down the line, you have to turn profitable. You can't tell me that, yeah, I've been operating for the last 15 years and I'm still a loss making entity. It doesn't make sense. So again, see, when you're looking at a startup, what they try to do is they try to portray a very rosy picture. And it's but obvious. So somebody has to come and do the marketing, and they'll always try and say that, okay, my future looks excellent. So today I'm a small company, I've got a market share of 1%, but over the next 10 years, this 1% will become 30%. This is what I plan to do. This will be the market share. This is the profit that I'll earn. I'll kill the competition. And this is where venture capitalists and private equities start funding it. Again, see, for them, it's altogether a different ball game. They don't invest in one company. They invest in like 30-40 companies, and they say that, okay, out of 30-40 companies, even if 5 to 10 are profitable and they can get the money, they're fine, because their returns are not like 5 or 10%. So those companies which are really profitable, they are the ones that will give them returns of hundreds and thousands of percent. But the losses that they'll make from the remaining 25-30 companies will cover up, the profits that they make from those 5-10 will cover up the losses that they incur from the remaining 25-30. So for them, it's a different number altogether. Hey, look at Zomato, Paytm, Byju's, loss-making entities, no profit, still getting huge funding. People are ready to invest, fine, because they all keep saying future looks good, future looks good. Look at Ola, Uber, loss-making, bleeding, but still people are ready to fund it. So it's all about how you portray yourself and what marketing you do. You just try and say that, yeah, I'll turn profitable in future, I'll make a lot of money in future, and that is how you convince your investors. Okay, finally, let's look at the last one, which will take me another, let's say, 5 minutes. So a balance sheet is as on a particular date. So let's say balance sheet could be for 31st March 22. When I'm looking at an income statement or a profit and loss account, Income statement is for a period. So income statement would be for the year ending 31st March 22, which means it is from 1st April 21 to 31st March 22. So income statement is for the period. Similarly, if I look at a cash flow statement is also for the period. See, a bootstrap company is when typically you start generating profits and those profits are put back into the company. So that's typically bootstrapping. So quickly, let's just look at what's a cash flow statement. Again, like I said, we'll be covering this in detail in the next session. What is a cash flow statement? So I'm just covering to that, Vijay, cash flow statement. So what is a cash flow statement? Now, cash flow statement, as the name suggests, it's a statement which talks about flow. Flow is nothing but change in cash and cash equivalent. So I'm looking at a statement which will tell me whether money is coming in or money is going out. So it's a statement which talks about change in cash and cash equivalent, whether money is coming in or going out. If money is coming in, you show it as a positive number. If money is going out, you show it as a negative number. Now, money could come in or go out from three sources. It could be from your day-to-day operational activity. So it's from your operations. So if it's from your operations, it is called as cash flow from operational activity. If it's from your investments, then you call it as cash flow from investing activity. And if it is because of the money that you've raised, that is finance, then it's a part of cash flow from financing activity. So from your day-to-day operations, so you do your sales, you do your purchase, you pay salaries to your employees, you pay electricity bills, whatever it is, you'll be generating some money will be coming in, some money will be going out. So whatever is coming in, you'll write it, whatever is going out, you'll write it, and then you'll take the net figure. Let's assume hypothetically that the net figure is 1,000 crores. So this company from its day-to-day operations is generating 1,000 crores of cash. Then we also look at investments. So you are buying property, plant, equipment, you're making factories, you have acquired any other company, you've done some investment, you bought bonds, shares. So when you do all this, money could come in, money could go out. So let's say in this case, the company has done investments, let's say worth 400, and it's a negative number, which means money has gone out of the company. And similarly, I could have money coming in or going out because of the way I fund my company. So let's say I've issued shares, I've taken a loan, I've raised money by issuing bonds, debentures. So again, money could be coming in or could be going out. Let's assume hypothetically, it's money coming in worth 200. So 1,000 crores is coming in from operations, 400 crores have gone out because of investment, and 200 crores have come in because of financing. On a net basis, during the year, the company has generated cash worth 1,200 crores. This 1,200 crores, if I add to my opening cash balance or the cash and cash equivalent, so let's say my opening cash and cash equivalent is 100 crores, what I'll get is my closing cash and cash equivalent. So I'll get a closing cash and cash equivalent of 1,300 crores. And ultimately, let's understand in finance, cash is the king. So marketing people would say customer is the king, customer is the king. In finance, cash is the king. You need cash to run your operations. You could be a profitable entity, but if you don't have cash, you will succumb, you will collapse. I mean, you can't go and tell your employees, I'm a very profitable entity, but I don't have cash to pay your salaries. I'll pay you salary the next year. Employees will start leaving. You can't go and tell your supplier, I'm a very profitable entity, but I don't have cash. I'll make a payment after 2 years. The supplier will stop selling the goods to you, and in fact, they'll drag you to court. So you need cash. So ultimately, cash is extremely important as far as finance is concerned. So this is a basic overview of a cash flow statement. Your cash coming in is shown as a positive number, going out as a negative number. Money could come in or go out from your day-to-day operations. Money could come in or go out because of your investments that you've done, or money could come in and go out because of the way you funded your company. That will tell you what is the cash generated during the year. To this, if you add your opening balance, you'll get your closing balance. So any doubt with the basic overview of cash flow statement? We'll cover this in detail in the next class. Yep. Or any questions with whatever we've done today? Any doubt, any query? Anyone? Yep. Any doubt, any query with respect to balance sheet, income statement, or maybe even the brief introduction of the cash flow statement that you've done? Otherwise, we can end it. We can wrap up the session. Can cash flow be negative in the introductory stage? Again, we'll look at it when we move to the cash flow statement. We'll again try and link it with the life cycle of a company. Again, if you look at cash from operations, as a young company, your cash from operations, chances are that it will be negative because you'll not be generating a lot of cash from your day-to-day operations. In fact, you'll be spending more, you'll be generating less. Typically, what will happen at the introduction stage, you will be generating a lot of cash from a financing activity because you go and raise money from your friends, relatives, venture capitalists, private equity. All these people will come. So this will be a positive number. Investment activity will be a negative number because you will be setting up your business. So you buy machines and all of that. So this will be a negative number, and chances are that your operations will also be negative. So this is something that will happen at the introduction stage. We'll cover this in the next session. IA structure, I'm yet to make the IAs as of now. So as of now, I can't comment and say what will be the IA structure. But then again, typically your IAs, definitely it's not an MCQ. So don't worry. I mean, I don't give MCQs. So it will be a descriptive question, and a descriptive question, either it could be a numerical question, or it could be a mix of numerical and theory, or I mean, where I say that, okay, solve it and give me an interpretation. What is the interpretation of this? What do you mean by this? Or it could be a normal descriptive question where I just tell you, okay, explain and tell me what do you mean by cash from operations, what is cash from investment, what is cash from financing. So it could be a straightforward question where I just tell you, okay, explain this, or it could be a straightforward numerical question, or it could be a combination of numerical and theory. So no MCQs. Yep. Okay. Thanks. Bye. Take care.